This video is for educational purposes only and does not constitute financial advice. Every investment carries risks, so make sure you do your own research or consult a licensed professional before making any financial decisions. Today, I'm going to guide you through what I call the ultimate ETF portfolio for beginners, a simple, well-balanced, globally diversified setup that you can start building right away. If you're new to investing, you've probably felt overwhelmed by the endless list of ETF, sectors, regions, and strategies. It can feel like you need a PhD in finance just to know where to begin. But the truth is, you don't. You can build an incredibly strong, long-term portfolio with just a few ETFs and a clear set of rules. And by the end of this video, you'll know exactly what steps to take. Let's start with the basics. Why ETFs? An ETF, an exchange-traded fund, is essentially a basket of assets, usually stocks or bonds, that you can buy on the stock market just like a regular share. The beauty of ETFs is that they allow you to own hundreds or thousands of companies at once without having to pick individual stocks. Imagine trying to choose the best companies from each country, each industry, and each market condition. It would take forever, and even professionals get it wrong. With ETFs, you skip all that complexity. You get diversification instantly and usually at extremely low management fees. Another huge advantage is that ETFs are transparent. You usually know which index they track, what companies are inside, and how they're performing. And the simplicity is unmatched. You can build an entire lifelong investment strategy with literally 3 ETFs. No day trading, no constant monitoring, just a long-term plan that compounds over time. So let's jump into the portfolio itself. This is a highly recommended structure for beginners because it's incredibly easy to maintain and automatically gives you exposure to the global economy. The allocation is 60% global stocks, 30% global bonds, and 10% cash or money market ETF. This creates a balance between growth, stability, and liquidity. Let's break down each part. The first chunk is 60% in a global stocks ETF. This single fund can hold thousands of companies from around the world. Large companies, mid-sized companies, and sometimes even small caps. You get exposure to the US, Europe, Japan, Canada, and emerging markets. Basically, you're investing in the world's productivity. When companies innovate, expand, create value, and grow profits, your portfolio grows with them. This is where your long-term growth comes from. Historically, global stock markets have shown strong returns over decades, even though they fluctuate from year to year. With just one ETF tracking something like MSCI World or FTSE Global All Cap, you can own a huge portion of the global stock market. Next, 30% goes into a global bonds ETF. This is the stability part of your portfolio. Stocks can be volatile. They go up, they go down, sometimes dramatically. Bonds, on the other hand, tend to move more gently. They act as a cushion during turbulent times. When stock markets crash or correct, your bond allocation helps soften the impact and keep your overall portfolio steady. Think of bonds as the anchor that keeps your ship stable during storms. A global bonds ETF spreads your bond exposure across many countries and issuers, giving you extra diversification. Finally, the remaining 10% stays in cash or money market ETF. This may seem like wasted potential, but it's actually very important. This part of the portfolio gives you liquidity and psychological safety. If an emergency happens, you're not forced to sell investments during a downturn. And if you want to take advantage of lower prices during the market dip, that cash is ready to deploy. Some people keep this in a money market ETF for slightly higher returns, while others keep it as normal cash. Both options work. Now that you understand the allocation, let's talk about how to build it step by step. First, pick your ETFs. Your broker will offer different global stock and global bond ETFs. Look for the ones that are broad, diversified, have low fees, and high liquidity. You don't need anything fancy. In fact, simpler is usually better. Next, Allocate your money according to the percentages. Let's imagine you're investing 5,000 euros. That would mean 3,000 euros go into your global stocks ETF, 1,500 euros into your global bonds ETF, and 500 euros stay in cash or a money market ETF. You can scale this to any amount. The proportions stay the same. After investing your initial amount, the next step is crucial. Set up automatic monthly contributions. Pick a day of the month, for example, the 1st or the 15th, and automate your investments. This is what turns a good portfolio into an incredibly powerful long-term machine. Automatic investing removes the emotional side of investing. You're not trying to guess the right time to buy. You simply invest consistently through ups and downs and let the market do its thing. Then, once a year, take a look at your allocation. If stocks have performed extremely well and now represent 70% of your portfolio, rebalance back to 60% by selling a bit of your stock ETF and buying more bonds. If stocks drop and you're now at 50%, buy more stocks to bring it back to 60%. Rebalancing forces you to buy low and sell high, automatically. And you only need to do it once a year. So what should you expect from this portfolio over time? Well, investing isn't a straight line. Some years will be exciting, with strong positive returns. Some will be flat, and some will be hard, with markets falling and headlines full of fear. But the key to success is staying consistent. Historically, globally diversified portfolios have grown significantly over long periods of time. Time in the market beats trying to time the market. Before finishing, let me give you a few final beginner tips. First, don't complicate your portfolio with too many ETFs. Simplicity is a superpower. Second, don't chase hot trends like ETFs, thematic ETFs, or sector-specific strategies unless you truly understand the risks. Third, focus on your savings rate. A good portfolio invested consistently beats a perfect portfolio left unused. And finally, think long-term. Investing is not a one-year project. It's a decades-long strategy. If you found this video helpful, don't forget to subscribe, leave a like, and drop a comment below. Tell me what part of investing you want me to cover next, or what other types of portfolios you'd like to see on this channel. Thank you for watching, and I'll see you in the next one.